All right, this particular webinar is going to be on apartment syndication and how to structure an apartment syndication. So we're going to be talking about deal structuring, including entity setups. We're going to be talking about, what is a single purpose entity and why lenders require this. We're going to talk about the definitions and differences between equity splits and waterfalls and hurdles and preferred returns. And then we're going to talk about and have a discussion on IRR, internal rate of return, versus ROI, that return on investment. So we're going to have a long discussion about that. We're going to be talking about annualized returns versus cash on cash. We're going to have a lot of different discussions on this. And this is going to be an interactive session. So if you guys have questions during this session, please type into the chat box or the Q&A box, and I will try to get to you as soon as I can. And it looks like this was a very popular topic, and it looks like we have reached our limit as the number of attendees we can have on this webinar. So I apologize ahead of time for those of you who are having issues with this. So if for some reason the code doesn't work that I gave you earlier before we got started, just refresh the page or maybe use a different browser and it should work. If you continue to have trouble, just shoot me over an email, dan@passiveinvesting.com, and be glad to be able to help you out there. So for those of you who don't know about it yet, we do have a summit coming up called the Mfin Summit. It's coming up in January 2020. We do this twice a year. You can go to mfinsummit.com to figure out how to register for it. It is right now being sponsored by Hunt Real Estate Capital as well as passiveinvesting.com. So you can find out some more information about them, as well as some of the other speakers that are coming up at this summit that's coming up in January 2020. So make sure you take advantage of that, and then click on this button here, take you to the sales page to be able to buy your tickets. So this is going to be one that's going to be happening January 16th, 17th, and 18th. So I'd encourage you to go ahead and check out that event and register for it. We do have a 30-day money-back guarantee. So even if you purchase your tickets right now, you have up to 30 days after the event to say, hey, I didn't like it, and no questions asked, we'll refund your money. So thankfully, we haven't had to do that yet, but we do have that on there in case somebody wants to do that. And so that's over 1,100 people that have been to the event and didn't ask for a refund at 30 days after the event. So very excited to be able to present that to you again. So let's go ahead and dive right in now to the apartment syndication structuring. And this will be about a 20 to 30 minute webinar. So make sure you stay tuned and get as much information as possible. One of the things that I want to talk about first before we get started is this single purpose entity and why it is required. So a lot of lenders, or most lenders, will require us to have what is called a single purpose entity. And that single purpose entity is created whenever we're trying to acquire one of these large apartments. And the reason why it's required is because a lot of entities that this has to be a single purpose entity, meaning that it's an entity that was created for the single and sole purpose of acquiring that property. And the reason why the lenders want that is because they want a new, fresh entity to acquire the property so that there is no, for lack of better terms, baggage, if you will, associated with an entity that's already been around for a while that is acquiring the property. And so a lot of these lenders are going to require you to have that single purpose entity because it is typically it is a non-recourse loan, and they want to make sure that there's no potential for future lawsuits or anything like that to ensue based on what that entity has been doing over the last 5 to 10 years or whatever the case may be. So that single purpose entity is created to protect and kind of shield some of the liability, if you will, for the acquisition of that asset. Now that single purpose entity is typically an LLC. That's the most common setup. And then inside of that LLC will be the equity splits, which we're going to cover as well. And so as far as the deal structuring is concerned, there are a couple of things that you want to be cognizant of while you're setting it up. So the first thing you want to think about is where do you want to set your preferred returns? And a preferred return is a return that is given preferential treatment to some portion of the capital stack, if you will. And when we say capital stack, we're talking about at what point are you putting in the capital to be able to acquire the property, and then at what point is that capital paid back when you sell the property or have a capital event. And so all the time, or most of the cases, the lender is going to be at the bottom of the capital stack, meaning they're going to get paid back first. And then after that is typically going to be the investor who's going to get paid back their equity portion. And then after that is going to be, on top of that would be the equity stack for returns for investors, but also the returns for the limited partners. So, and I'm not sharing any slides right now. I actually just have the structure and apartment syndication website up. That's kind of my outline that I'm going off of right now. Most of my webinars, for those of you who have been to a couple of them, I usually am trying to, I don't like to use slides too often, and the reason why is because I like it to be a little more organic a feel. So I apologize for those of you who like the webinars that have the slides, but it's just not something I do very often. But occasionally I'll do them, but usually I try to go off of the outline and go off the slides there. And any questions that come in from the content, I'll answer those. I'll answer those questions as well. So thank you for bringing that up, Sydney. All right, the next thing here is about that deal structuring and that preferred return. So the first thing you ask yourself is where are you going to set that preferred return? And a lot of times those preferred returns are set based on how good the deal is, or how much you need to give to the investors versus keeping for the general partnership. So there's two parts of a syndication. There is the investor part of the entity, and on the other side is going to be the general partnership part of the entity. And so usually, like in our situation with PassiveInvesting.com, which is the group that I'm part of, with the way we structure our projects is we do a 70-30 split. So 70% of the deal of that single purpose entity is owned by the investors, and they get a piece of that 70% based on the amount of money that they invest based on the amount of money they invest for the amount of total equity required to be able to acquire the property. And then the 30% is reserved for the sponsorship team. And so a lot of times people will think the moment you close on a property, you immediately own 30% of that property. And you do immediately, as the sponsor, own 30% of that property. The problem is that 30% is worth nothing when you first acquire, because you had closing costs, you had fees that you had to pay out for acquisition fees, and various fees like that for acquiring the property, and transaction fees and inspection fees. And then you also have the equity. So when you go to sell that property, you have to now pay back the debt. You also have to pay back the investors, including their equity. So you really technically have no profit in that business immediately day one. You have to prove that business plan and perform on that business plan in order to start to bump the NOI to be able to get over and above that equity piece, to be able to have that nice return for your investors, but also for you as the general partnership, or as that sponsorship team. So it's typically split up 70-30%. Sometimes you'll see it lower than that, depending on how good or bad the deal is. So it might be 80-20 or 90-10 or whatever. Just depends on where people are in their how they're underwriting their projects. And hopefully some of this stuff will help you with that. I've done some webinars in the past that kind of helps break down some of those other underwriting nuances. But I'm going to be doing another webinar soon that will help to break down some of those as well, on what a passive investor should be looking for. So make sure you stay tuned for that as well. I want to do a quick sound check just to make sure. I know somebody mentioned that they can't hear me very well. So can everybody hear me okay? If you can hear me okay, just say yes, 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 yes. If you're having issues, let me know as well. Okay, looks like I'm getting all yeses. So Bill, it might be on your end, so I do apologize for that. All right, cool. And Catherine just signed up for the summit. Thank you so much, Catherine. Registered for the summit, and she even upgraded her ticket to VIP access, which includes the networking mastermind before, as well as the investor toolkit. So great. Thank you so much for registering there, Catherine. If those of you who are interested in registering, you can go to that mfinsummit.com website and register and type it in there for that. So thank you for doing that audio check real quick. Somebody had also asked about what is my preferred return or my preferred rate on our deals. And so most of our deals have been either at a 7 or an 8% preferred return. And what that preferred return does for investors is it protects a little bit more of your downside before the sponsorship team gets their split. So it looks like Daryl also registered for the summit. So thank you so much, Daryl, for registering for the summit coming up. Again, that's going to be January 16th, 17th, and 18th. So the preferred return is as returns are coming off of the property, whether it be, there's two main places where that comes into play. Number one is the cash flows monthly off of the property. And the second is going to be on a capital event. What I mean by a capital event is either you're putting a supplemental loan or refinancing the property and are able to return back money to investors, or you are selling the asset. Those are the three main capital events that you might have during one of these holds on one of these larger acquisitions. And our group likes to stay inside of that B+ asset and an A- and A+ area, and have the potential for, increasing, doing some renovations, improving the community interior and exteriorly, and be able to increase the rents and bump that NOI to have those nice returns and kind of juicing that for investors. Our group looks right now for a minimum 20 million in acquisition, minimum 200 units. Right now, we're actually looking at a deal in the Raleigh market that's going to be right around that $70 million mark. So we actually have been this morning kind of going back and forth with the partners to kind of see where we're going to be able to land with that particular project in the Raleigh market. But that's just kind of where we are. But the way we do it is we have that 7 or 8% preferred return that gets paid to the investors first. So before the sponsorship team gets their equity split of, say, 70-30, then that 70-30% doesn't come into play until that the investors get that 7 or 8% preferred return. And the way we do it at PassiveInvesting.com is we actually provide that 7 or 8% preferred return paid out monthly. So, and that starts immediately after we close on a property. So we just closed on a property at the end of October. It was a $51.5 million project out of Raleigh, North Carolina. And we are giving our first distribution on that property based on a 7% preferred return starting in December. So just a month later. So we wait to have a full month of operations under our belt with that property. And then from that point forward, we'll do monthly distributions. So we don't wait 6 months, 9 months, a year to start those distributions. We only get into a deal that has strong cash flows, and we can start to do those distributions right away. So we buy stabilized assets, safe, stabilized, lower risk assets that allow us to have those cash flows to be able to give those returns. All right. So Sydney is asking a question here that says, well, Stuart asks a question first. Where is the summit being held? The summit is an online virtual summit. So there is no location. It can be wherever you want to be. But all the sessions are recorded. It's 3 days. And to register for that, just go to mfinsummit.com. So thank you for that question, Stuart. And the question that Sydney has here is, so the GPs get 22% when there is a preferred return of 8%. And that's not technically correct. So they're not going to be giving up a percentage of that 30%. It's that 70-30% equity split doesn't come into play until the investor receives that preferred return. That preferred return gets paid first, and then there is an equity split from that 70-30%. So it's not technically, they're getting a lower percentage, so they're only going to get 22%. It's not calculated that way. So the way it happens is they're going to get that 7 or 8% preferred return first, and then everything after that split 70-30%. And that 70-30 is where that equity split comes in after that preferred return. I hope I'm not confusing you, but if you have need some further clarification on that, please let me know in the chat box. And if you're watching this afterwards on the recording, shoot me an email, dan@PassiveInvesting.com. Glad to be able to help you out and clear that up for you. Next question I have is coming in from Jose. How and who manages the accounting for the distributions? So the sponsorship team, along with the property management team, is going to be the one who's going to be managing those distributions and doing the accounting for that. So the nice thing about the way we do it is we have a pretty straightforward and predictable monthly cash flow that gets distributed to investors, because we do those distributions based off that 7 or 8% preferred return. So if an investor invests $100,000 in our projects and they're getting 8% preferred return, that's going to be $8,000 a year divided by 12. So they're going to get a little over $666 a month and some change for that entire hold period. Now, that's what we do to have predictable cash flows. But then at the end of every year that we're holding on to the property, we'll see, is there any additional cash flows over the preferred return, over the 8% that's already been distributed to investors? And if there is, then we'll distribute additional return to the investors on top of the preferred return that they've already been receiving. So that's something that we always do for our investors to, have some predictability in our cash flows. Then also, if there's extras at the end of the year, be able to disperse that and distribute that on top of it. So good question there. And Mark has a question on here about are you structured as a GP LP? The question is yes, that's correct. It's a GP and the LP. And does this structure only allow you to work with accredited investors? So we do two different types of offerings. We do a 506B as in Bravo, which allows us to be able to accept up to 35 non-accredited but sophisticated investors. And we also do some, not very many, but we've done a few. Really, of all the ones we've done one of what's called a 506C offering. And we did a webinar on the differences between those two. So if you want to go to our YouTube channel and figure that and Google that, or not Google it, but search for that, you'll find it. And so we typically do a minimum investment of $50,000 in our deals, and we accept some non-accredited, sophisticated investors. But then on a 506C offering is where you can only offer it to accredited investors. The benefit to the 506C, though, is that you can actually advertise the project more publicly. So the 506B offerings, the ones that we do, are private offerings, meaning that you won't even know that I have an offering available unless you went to passiveinvesting.com, you filled out the investor form that was on there, you and I jump on a call, discuss your investment goals, we add you to our investor distribution list after we have that pre-existing substantive relationship that the SEC requires in order for us to be able to give you an offering. So if you are interested in that, obviously, please do that. Love to have you as one of our investors. But that kind of answers your questions about how these various things are structured and set up. I know Jose had a follow-up question in there about how do you find investors for your deals and how do you market for them. We did a webinar on that recently, so go to the YouTube channel. You just go to the multifamilyinvestornation.com/MFIN webinar where you signed up for this webinar. You can actually click on the link at the top here that says YouTube, and it will bring you straight to our YouTube channel. Or you can just go to YouTube, type in Multifamily Investor Nation, you'll find it there. So feel free to do that as well. And it says, do your type of syndications work anywhere in the country? Is a licensed security attorney required to set it up, and who covers those costs? So yes, these types of syndications can be set up anywhere in the country. We do work with an SEC attorney, so you want to make sure that you do have a licensed attorney to be able to help you with this. It is highly advisable. The one that we use is Dugan Kelly. So if you want to reach out to him and tell him we sent you, you can certainly do that. He's a good friend and has helped us out quite a bit. And this particular person, the cost for setting this up is actually what the investors will distribute to them as well. So make sure that you do your due diligence and hire the proper attorneys. And when we raise, say, for example, on that last deal I talked to you about in Raleigh, we raised $14 million. Included in that $14 million was the cost for setting up these entities. So good questions there. Next question here, how many companies you have to have in order to purchase the property? So I think the question here is really how many entities need to be set up in order to acquire the property. So technically there's only two entities that need to be set up in order to acquire the property. There's going to be the entity. Let me see if I can actually get my whiteboard up here. Hold on one second. Let me see if I can put my whiteboard up here and draw this out for you, because I think it might be helpful. I might have to stop my screen sharing, I'm not sure. Annotating. Let's see. Can you see me drawing on the screen here? If you can, just type in yes, yes, yes on the screen. Okay, good. All right, so I'm going to clear these drawings real quick and clear all drawings. And I think if I stop the sharing, I can actually open up a whiteboard. One second here. For some reason, it's not letting me open up a whiteboard here. Oh, here it is. There's my whiteboard. All right, so you guys should be able to see a whiteboard here. Type in yes, yes, yes if you can see the whiteboard there. And we should be able to now see my my drawings on the screen here. You see all that little black scribble, scrabble? All right, let's clear these drawings real quick, and I'm gonna maybe make this red so you guys can see this. So the way we typically structure our projects is you're gonna have a box down here, which is what I'm gonna call the single purpose entity. So hopefully you guys can see all this. That's gonna be the single purpose entity that is set up to acquire this property. And so there's gonna be 70% in our projects that is going to be owned by who? Type in the chat box. Who is this going to be owned by? See if you can figure it out. If you were listening and paying attention, that's correct. That's going to be the LP, or we can type this also in as the investors. So good question. I'm sorry I'm using my mouse to do this, so it doesn't look that good. But at least you guys can see and understand the structure here. And then so this is going to be entity number one, right? So this is going to be one entity that you create. The LPs and investors might come in with their own entity. Most of our investors come in as individuals, so you don't necessarily have to come in as anything other than just the LPs. We don't think about that as far as who comes in at that. The other side is going to be the GP, right? It's going to be the general partnership. So this is going to be the GP side that's going to own this piece of it, and they're going to own 30%, right? So this is the 30% that we were talking about. And the GP over here typically is another entity. So this is going to be, entity number two that is you're going to want to create. So technically, you only need to have two different entities. Now, one of the additional things that our group does to protect, the partners within the manager entity is we'll have another entity. Since we have three different partners, we actually have three different entities for partner number 1, 2, and 3. And each one of these is a different entity that actually invests in, that doesn't invest, but is actually part of the manager entity right here. But it's basically, if you wanted to look at it another way, you could just have three different individuals that are that own the portion of the GP of this particular sponsorship setup. So, but this is just kind of how we set it up. And if we bring any other co-sponsors on to help us out, then they might come in with a different entity into this general partnership, depending on how it's actually set up. So with this number 2 entity, somebody's asking, is a multi-member LLC, and yes, that is correct. And this is typically, the manager entity is typically, in our situation, we usually do a Delaware or typically this one's a Delaware LLC. And then interestingly enough, these three entities that come in as the entity are actually Wyoming LLCs. I'm not going to get into the different nuances as to why we do Wyoming versus Delaware and all that kind of stuff on this particular webinar. But if you're interested, I would be glad to do another webinar to talk about that. We just don't have enough time on this today to talk about that. And Kelvin's asking me, are we going to be talking about waterfalls? Yes, we are. So we're almost done with this. I know I had a couple questions about this, so I wanted to make sure that we're going to be doing this. So if there's any other further questions about this, let me know. But technically, you only need 2 entities. This single purpose entity has to be, or most lenders are going to require this to be, an LLC in the home state of the property. So that deal we did in Raleigh, this was actually a North Carolina LLC. And we had the GP manager entity, which was a Delaware LLC. And then we had our other owners within the GP that these were actually not Delaware LLCs, they were actually Wyoming LLCs. So, but technically you only need 2 LLCs, and hopefully that cleared up a little bit on these particular things. So it says which entity receives the acquisition fee and the asset management fees, and that would actually be this GP would be getting those acquisition fees paid into that entity to be able to split amongst the actual GPs. So anyway, so I hopefully that covered enough on there for you. And thankfully I was able to use the drawing board here to be able to clear that up for you. Let me go back to the other piece. I'm going to stop the share here and share the screen back again on the screen we were just on to stay on top of this. So is the reason the location based because of the tax purposes? No, it has something to do, Jose, with the lender wanting it to be owned. If there's any litigation or legal issues, they want it to be owned by a South Carolina or a North Carolina or whatever state that property is. And those are the 2 main states we work out of. We do Greenville, South Carolina, Charleston, Raleigh, North Carolina, and then whatchamacallit, like Charlotte, North Carolina. So couldn't think of that. So that's the good thing there. We got lots of questions on here. You guys are giving me a lot of good content to be able to drip feed out. So if I don't answer your question today, I will do my best to respond to a lot of these questions on our other social media platforms. And let me do this for those of you who maybe haven't been following us on Instagram. We've got a good Instagram page here that you can follow me on. And I'll type it into the chat box here so you can follow me on Instagram. And as we answer some of these questions that maybe we didn't get to, you'll be able to follow us there and follow some of those responses. And glad to be able to do that with you. Also, I'll give you, we post these also on LinkedIn. So let me give you the link to my LinkedIn profile so that you can follow me on there as well. Let me see if I can get there it is. Here's my profile on LinkedIn. All right. And let's move on to the next piece here. So we talked about deal structuring, including the entity setup, the single purpose entity and why it's required. We talked about equity splits and preferred returns. And so I want to talk about these two things right here, which are these waterfall structures and hurdles. So the hurdles are actually within the waterfalls. And where I think a lot of people get mixed up is, or get confused, is when they start to think about waterfalls and hurdles and how they relate to the equity splits. Because what can happen in the waterfalls and these hurdles is that the equity splits can change based on certain performance metrics that the property hits. And so, for example, what we do in our properties is that we actually have a preferred return. So we do a 7 or 8%. So let's just call it a 7% preferred return. And then we do a 70-30 split up to a certain IRR. And that would be what is called a secondary hurdle. Because the first hurdle is the first split at that 7% preferred return. So technically, the investors are getting 100% of the proceeds until they get returned 7%. And that's the first hurdle, right? Then once they get to that 7%, it splits to a 70-30%. So actually, let's actually go back to my whiteboard, because I think that will actually be a good way to explain it, is to show you those differences in these different hurdles. So hopefully you guys can see my screen again. It should be back. And I'm going to change the color to blue just to keep it different. So we're going to call these different hurdles. This is going to be hurdle number 1. Okay, call this hurdle number 1, and then we're going to have hurdle number 2. This is an easy way to explain the hurdles, and then I'll also explain the waterfalls, which is very similar to the hurdles, but I'll explain that. So we're talking about, the return metrics, right? And so investors are going to get paid 100% of the return up to what is called the 8% preferred return, right? So we have this 8% preferred return, and then after they get paid back this 8%, now the equity splits change to 70-30. So 70% to the investors or to the LPs, okay? And then you're going to have the GP is going to get the 30%, right? And then what's going to happen is that there's a lot of times it's just set up so that there's was one split, that's it. There's only one hurdle. In our projects, what we do is that once we hit another performance metric, which we typically do the IRR, which after this explanation, I'm going to give you the explanation on IRR. But right now, I want you to understand this a little bit before we talk about that. And this could either be IRR or it could be ROI. But I'm going to explain to you why this ROI is not usually used in these situations, because it doesn't paint a very accurate picture. And I'll explain to you why. But once we hit a certain IRR, so I'm going to go back to that deal we did in Raleigh, right? So we actually did a 7% preferred return, and then we did the projections called that we were going to give it back investors a 16.2% IRR, okay, that internal rate of return. And so that 16% IRR, once we actually hit that 16% IRR, the equity splits change. So it actually changed to 50-50. So the investors get, the general partnership or the sponsorship team gets rewarded, if you will, for overperforming the property. So the investors are still getting a nice spread on top of the 16%. They're going to still get 50%, but then the sponsorship team gets 50% as well. Some properties and some groups after this hurdle will have another hurdle, right? So that it might split to 30% for the for the LPs, and only 70%, or 30% for the LPs, and now a 70% for the GP. And all of these different metrics, so this might be, 20% IRR. This would be hurdle number 3. So this is what we're talking about as far as hurdles are concerned. This would be a hurdle that the returns have to get to, which would be hurdle number 1. This would be another hurdle, and then this one would be another hurdle. So this is actually these different hurdles that are occurring here. So are there any questions about this, or does this make sense? So raise your hand if this makes sense. So there's a little button there that says raise your hand. Just raise your hand, say this makes sense, this makes sense. For those of you on the phone calls, obviously you can't raise your hand, but if you have further questions about this, you can certainly shoot me over an email, dan@passiveinvesting.com. Glad to be a resource for you and help you out. So looks like we're pretty clear on this. Everybody's raising their hands. And I'm going to go ahead and lower these hands here in case I have another question here. So let's see here. All right. Questions here says, examples of timing for the hurdles. So these timings are so typically these hurdles only come into play when there's some form of capital event, but this first hurdle usually comes into play with this preferred return with the cash flows as well. So in our projects, we're going to give 8% of the preferred return to the investors, and then if there's anything over and above that, and we split after that year, and we say, is there anything over and above the 8% that we can distribute? Then anything over and above that 8%, 70% is given to the investors, and then 30% is given to the GP. But the timing on these things all are deal specific, so it's kind of hard to come up with that. And the next question John has is, how do you come up with the 16% IRR? So I'm going to explain the IRR here in a minute, which will hopefully clear it up for you, but the IRR is different with that. Catherine is asking, does the GP invest as well? And in some projects, they do not. In all of our projects that we put together, we want to align ourselves with the investors, and so we do invest alongside of our investors in each one of these projects. So, on the sponsorship team, on the most recent deal, we were raising 14 million. We put in 1.4 million alongside of our investors as the sponsorship team. So we always make sure that we're aligned with our investors. So hopefully that answers your question for that. So again, some of you don't know a lot about me and my background. I won't go into it very detailed, but the reason why I'm putting these together is also a selfish reason. I want a place to put some of my own money as well. So I own a couple of medical offices here in South Carolina, and also an online company that does 7 figures of revenue. And so I have cash that's being spun off every month, and I need a place to be able to put that, to be able to reduce my taxable liability, and that's what we do. So good questions there all around. So let's dive into this question about, I know there's a couple other questions in here as well. So Kelvin's actually asking, is the waterfall the flow of distributions based on the hurdles? And that's correct. So typically the way you want to think about this is kind of like a waterfall. So usually in a waterfall structure, you should be able to see on my screen here. Let's turn this to green just for fun. You'll usually have a bucket here, and then underneath this bucket, you'll have another bucket. And I'm not putting these to scale or to size or anything. I'm just giving this to you as an example. So typically what'll happen is in a waterfall structure, we're going to have, and I guess I could turn this to blue since it's water and we're talking about waterfalls, if you will. But each one of these things would be the different hurdles, right, that you want to achieve. And so as money is coming into the property, the money is going to fill up this bucket first in the waterfall. Once it hits that 8% preferred return, which fills this bucket up, then the rest of the cash and the money is going to go into the next bucket until it hits and achieves the returns that would fill up this bucket until you get to that next hurdle. And then this bucket would be filled up, and it would go down and fill in the next bucket, and so forth. So that's what we're talking about as far as the waterfalls and the hurdles. And again, hopefully that makes sense to you as well. If it makes sense to you, raise your hand on the webinar here, and just let me know that you understand that and it makes sense to you. And then I know you're paying attention. So we got a ton of people on this webinar today, which is exciting to have. And then we're going to break the Zoom meeting platform that we're using. So that's great. So the one question I have in here from Ed is, how many hurdles do you typically have in your deals? So we typically only have 2 hurdles in our deals. So we'll have the original 8% preferred return hurdle, that once we hit that preferred return, we split 70-30. And then once we hit a performance metric, which is the IRR that we project that we're going to get to our investors, we'll have a 50-50 split after that. So it just depends on the project and depends on the deal as far as where this secondary hurdle comes in. But at least we'll have one, but we typically do put a performance hurdle in there as well. So good questions there, and appreciate all of you guys who raised your hands and let me know there. Let's see. So Bill's asking, do you invest as the sponsor or as a GP, then with capital as the LP? So we invest as the GP alongside of our investors. So we actually have part of the LP side of the project and the GP side of the project. So if there's, like I said before, like 14 million that we're trying to, raise to be able to acquire a large property, then 10% of that we will invest as the GP at a minimum, which would be the 1.4 million. If it's 8 million, then it'll be 800,000. So it just depends on the project as far as that's concerned. Let's see, do you work anywhere in the Northeast, Pennsylvania, Ohio? I do not. If not, you have connections in those markets. I don't have anybody that actually is doing some things in those markets, but I will tell you, if you join our closed Facebook group, you should be able to put a post on there and see about trying to find some people in that group, because we have a pretty active group. And I bet that we can reach the 5,000 member mark for everybody who's on the webinar today. So we're about to reach that. We're about 20 to 30 people away. I'm going to type in the chat box for you right now that will allow you to click on this and join. So you do have to fill out a little application to get in, but it's fairly quick and easy to join. But if you can go there right now and join the closed Facebook group, we do have a lot of interaction that happens on the Facebook group. So hopefully that will answer some of your questions there that I'm not able to answer for you here. So let me stop the share here and go back to our other screen, which is where our outline is. I have a lot of questions here in, and give me just a minute. I need my charger. It's upstairs. I'm about to die. My battery, my laptop bag. I got to grab my chargers. My laptop's about to go dead here, so I apologize for that. And let me see here. All right, so hopefully I don't die on you here. I got like 24 minutes left on my battery, but when you're doing a webinar, it kind of takes a lot of the juice out of the way. So hopefully I don't lose this. I should have planned to plug in my laptop. I had just switched up some of the things and unplugged it and left my laptop charger upstairs. So I have somebody going to grab this. Actually, my beautiful wife is the one who's going to grab this right now. And hopefully we can get this going. So, all right. So I won't try to worry myself about me going dead on you guys, but let's go ahead and talk about the internal rate of return and the ROI so we don't lose track here. So the internal rate of return is obviously the IRR, and a lot of people get confused between IRR and ROI, that return on investment. And for one, I want you guys to help me out here, and I'm going to give you a scenario, and I want you to tell me within the chat box whether or not it's a good idea. So give me just a moment here. Let me get us plugged in. 1 second. Thank you, babe. All right, we are plugged in. We're good to go. So we shouldn't lose you guys here. And thanks to my beautiful wife for helping us out there and grabbing that. So, all right. So I'm going to give you a scenario, and I want you to tell me within the chat box when I ask the question what your answer would be with this. If I have $100,000 that I want to invest into one of these types of syndications, and I told you that I put $100,000 in and I got $200,000 out, is that a good deal? So go ahead right now, type in the chat box, is that a good deal? If you want, just raise your hand, but tell me, is that a good deal? I put in $100,000 and I got $200,000 out. So I'm getting lots of raised hands. I'm getting a lot of people saying yes, yes, yes. I have a few people that might be knowing what I'm doing and are actually saying depends. And for those of you who are saying depends, that is the exact reason why we look at the IRR. And so The ROI is again, let me go back. So we said if you put in $100,000 in, you get $200,000 out. A lot of you, most of you are saying, yes, absolutely, great deal. But I forgot to tell you that it took me 30 years to get that back. Now, in the chat box, is that a good idea? I mean, was that a good return? Would you invest with my company if I told you that it took 30 years to take your 100,000 to 200,000? Obviously, all of you on here are saying no, 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 absolutely not. So one person said still better than the savings account. So obviously, there's definitely some different nuances there to think about. But that's why we look at the IRR more than we do the ROI, because somebody just said if it's 1913, that's a good return. But so the ROI, the fault with it is that it doesn't take into account time. It doesn't take into account how long it took you to get that money back. And so ROI is good if you're like doing single family flips or things like that, or you're wholesaling a deal or something along those lines that's short term, less than a year. It's okay to look at the ROI, because you're not really concerned too much about time, even though IRR would still give you that better picture. But a lot of real estate investors don't even know about IRR. And when they start to get into this apartment syndication space, they get confused. And they're like, what is this IRR? I've never heard of this before. I've only heard of ROI. Well, IRR is very similar to, the IRR is very similar to the ROI, except for it takes into account the time that it takes for you to get that return. So that $100,000 is, if I invest in it and I tell you I'm going to get you a 16% IRR, it's telling you how that IRR goes higher the faster I can return that initial capital back to the investor. And so when you look at the calculation for IRR, that calculation is a negative number until over time, until I give back all the initial capital back to the investor, and then it becomes zero. And then at that point forward, it starts to become a positive IRR. Most likely that's not going to occur until we have a capital event. And again, we talked about those capital events earlier, but that capital event is that supplemental loan, the refinance, or the sale of that asset. And that capital event is when you're going to start to have that positive IRR. But it tells you when you're comparing one deal to another deal, how good it is. So you want to make sure that you always are looking at that IRR. So if you look at a deal that's maybe being held for 7 or 10 years, and they're only giving you a good picture of how good the ROI is, you might want to step back and figure out what the IRR is for that calculation. Now, the IRR calculation is a really long formula. It's very complicated. It's very hard to calculate. The best way to do it is to search on Google IRR calculator, or you can also use Excel. Excel has an Excel formula in it to be able to use it. And unless you're like our financial analyst and financial partner in our team that actually did it longhand to really understand it, then I would suggest just using the formulas. But it's very easy to put those in there about the initial capital and at what points throughout time are you receiving that capital, and it tells you how fast you're getting those returns. Because the faster you can return that capital, the faster you can deploy that capital to continue to increase your return even more on top of the capital that you're getting returned. So hopefully that cleared it up a little bit about the IRR versus the ROI and how that's actually calculated on these different types of deals. So if you understand how that works, raise your hand. Let me know that you understand that. Also type into the chat box, yes, yes, yes. Let me know. Great, great, awesome. Got a lot of people understanding this. That's great. Got a few people that might not understand it completely yet, but maybe when you watch the replay or go through it again, or maybe do some examples there, you can figure out how the IRR is affected based on how fast that capital is being returned to the investors. All right. The last thing we wanted to cover today, and I know we've covered a lot more than what we had originally planned, which we only have about 9 minutes left on this webinar, but the annualized return versus the cash on cash. That's what we're looking at right now. Let's see here. Oh, got a few more people that's registered for the webinar, for the summit coming up. So that's great. That's awesome. Great. Got over a dozen people that's already registered. So that is awesome. I was just checking my phone real quick because I have something that's supposed to be showing up here right at 3 o'clock. And I have another meeting at 3 o'clock Eastern. Just wanted to make sure that they can get in. So, all right. Sorry about that. Annualized return versus cash on cash. So the cash on a property is I've put in a certain amount of money into the property, and if I'm going to be getting 10% cash on cash, it's based on the amount of money that you put in, right? And so if I put in $1 million and I have 10% cash on cash, then that means I'm getting $100,000 a year returned to me from that cash that I initially put in. And so that's the cash on cash. Now the annualized return is going to be the return that you're given. It's very similar to that ROI calculation, right? But it's annual. It's basically annualized. So the annualized return is more akin to that ROI annualized out over a year period of time. So it still doesn't take into account, the time value of money or anything like that, other than just kind of annualizing it over time. But it's basically saying I put in the project, if it's 3 years, 5 years, 7 years, 10 years, I put in 100,000, I got 200,000 out. You divide that by the number of years, and that gives you that percentage of return, right? So you know how much that return is. So you figure out what the percentage return is, and then divide that by the number of years that you're putting it in, and that gives you that annualized return. So Daniel just also messaged here, said that he registered for the summit. Thank you so much, Dan, for doing that. So let's see here. For the summit, paid registration, will a video replay be available afterwards? Yes. So if you register for the summit, you can only attend a few of the sessions or none of the sessions. As a paid attendee for the summit, you will receive the recordings of all the sessions. So you'll have access to that for sure. So make sure you sign up for that. All right. So hopefully that answers your questions from everything we talked about. I know there's a few questions still here on the chat box. I'm going to try to get through as many of these as I can over the next couple of minutes. And then we'll wrap it up here right at 3 p.m. Eastern. So thank you guys so much for all the questions. I got lots of content, lots of videos from all these questions. So we do save the chat box and the Q&A box to see what questions people have, and what if we don't. So Chloe is asking, is the $100 VIP access worth it if you only watch the replays? Yes, Catherine, I would say it is worth it, because we have networking opportunities that we do virtually with our VIPs. Plus, you get the VIP toolkit with a few things that will help you be able to analyze some deals, whether you're an active investor or a passive investor. So definitely say it's worth it. We actually typically charge $200 for that. So right now we have it at $100. So for those of you who want that VIP, go ahead and register for it now before we increase that. So thank you so much. Looks like we have I can't pronounce the first name, Vivishka or Vivisa. Hopefully I didn't botch that too bad, but has registered for the summit. So thank you so much for doing that as well. If someone wanted to start with multifamily investing by joining an existing active deal, what would it take to come in as a GP? So, I mean, it depends on the operator and what they're looking for, but typically most operators are looking for somebody to come in and help somewhere with, underwriting, asset management, acquisitions, somewhere along those lines, risk money, loan guarantor piece. There's lots of different activities. And of course, the one piece that a lot of people are looking for as well is equity raising. So if you have a lot of high net worth individuals in your network that are interested in investing in these projects, and you want to do something to help, then raising capital for these projects is a good idea as well. The biggest thing is that when you raise capital for these projects, you have to do something in addition to just raising capital. Like, you can't just join somebody's team just to bring equity. You have to do something else and some other responsibilities. And so if that's a conversation you want to have, we can obviously maybe even do another webinar on that topic as well. So that I really enjoy and really like these webinars. So maybe be able to do that as well. All right, I'm gonna go back to the chat box here. If you guys have questions, feel free to type them into the chat box and I'll do that. One question in here from Stuart was, how long is the hold period? Most of our projects we do for a 5-year hold period, and mainly because that's gonna be the maximum return for investors, but also the maximum amount of depreciation that we can get front loaded in the first 5 years. So every 5 years, we want to go into a different asset, do a 1031 exchange to defer the capital gains and allow us to be able to defer that capital gains into as long as we can. And then it also allows us to reset the depreciation every 5 years when we go into a different property. So good question there. All right, let's see here for another question. Depends on how long, what percentage of talk required to raise a fund. So Jay Cohen is asking, what percentage of the total acquisition cost do you raise, then get funding for the rest from a bank or a lending institution. So it really just depends on the project. It depends on the deal. So typically our leverage points are around 70 to 75%. Unless we're using a bridge lender, then we might go up to about 80%, 79, 80% of the total acquisition cost. So it really depends on the lender, whether they do loan to value or loan to cost, and what kind of debt is available from the various lenders at that particular point in time. So good question there. How do I get in touch with you to discuss coming in as a GP to your existing deals? So you can just shoot me over an email, Sydney, that email, dan@passiveinvesting.com. You can feel free to do that. Sohail has a question here from Canada. Good to see you on here, Sohail. In regards to the monthly distributions paid immediately after purchase, is this amount coming from the NOI? Yes, it is. And what if you promise a certain percentage preferred return, but the NOI doesn't cover this promised amount? So Sohail, that is a potential, possibility that could happen, where the NOI, the cash flows off of that property, drops below the amount that we can distribute to investors. And in that situation, they would get a lower amount for that monthly distribution. So thankfully, on none of our projects have we not been able to hit that preferred return and hit those monthly distributions. So that's good, because that's how we underwrite it. We want to make sure we hit those preferred returns. Want to make sure we hit those monthly distributions. So it's a good question. But if it doesn't get hit, then it does lower them down. Now, that kind of goes into another topic of what is called a cumulative preferred return or a non-cumulative preferred return. And that cumulative preferred return would mean that if for some reason 1 year we don't hit it, so let's say I'm giving you a 7% preferred return and 1 year I only gave you 6, the next year it goes up by 1 percentage point. So that next year would be 8% preferred return. That would be a cumulative preferred return. So when you're looking at these offering memorandums, make sure you look for that cumulative preferred return and not what's called a non-cumulative preferred return. And I always suggest that you look for deals that have preferred returns and just try to stay away and shy away from the ones that don't, because they're not necessarily aligning with you as well on that. All right, so I know you guys have lots of additional questions. I have no more time left on the clock. If you have any further questions, shoot them to me. I'd love to be able to respond to any questions that you have. Thank you for the responses here, and thank you for those that signed up for the summit. Make sure you go to mfinsummit.com and register. For those of you who are interested in joining us, one of our future projects, obviously feel free to go to passiveinvesting.com and do that. Thank you again for everybody saying thanks on the chat box. I really appreciate it. I will do my best over the next couple of days and weeks of putting out some additional content and videos. So make sure you follow us on the various platforms that you follow us, and look for some of the videos. So thank you so much, and look forward to seeing you on a future webinar.